people are taking of course, and depends, as you said before, what is your investment horizon? If you're not already underweight at this stage, and we think there's in the US, for example, another 10% to go. And of course, we know it's very difficult to time the exact bottom. This probably isn't the time to be moving to that underweight position now. So for those investors, they're probably going to stay invested, maybe just hugging the benchmark. Others are then shifting, for example, over to treasuries, to any kind of safety that they can get into, maybe adjusting their allocations within equity to slightly more defensive sectors, but really gearing up. Now, if you're thinking about the UK, on the other hand, there's a slightly different conversation going on, which is that they're looking out over the next 1 year, 5 year, 10-year horizon and saying, okay, is the UK, relative to all of the global regions that we look at, really a country that we want to invest in? And whereas for the US, there is, I think, a resounding yes, over the next 10 years, equities will be higher than where they are today. For the UK, it's probably a bigger question of how much higher they're going to be. And do we really believe in the UK going forward as somewhere that we want to be placing our money?
Yeah, it's tricky because when you say underweight, I mean, what you're saying is long but less long. So, you know, the floating boat will go down as well, even if you've got a smaller boat. So, I mean, what are you doing with your cash if you're not in them, or if you're underweighting equities? I mean, bond markets are falling aggressively as well. Jeff just mentioned that with the bunds as well. Holding in cash in an 8-9% inflation environment. So I know that we've talked about Tina and Trina a lot over the years, but where do you put your money if you're underweighting or taking money off the table, or have taken it off the table?
You're right. And, I think one of the key trades that we have seen is, of course, people moving into government bonds, which, as we know, has had some very, very sharp moves, which would have done a fair amount of damage. So from our perspective, look, we do need to get defensive. If you're investing in credit, go into high quality. If you're investing into equities, go into defensive. So there's all those kind of things. But from an asset class perspective, this is still kind of the environment for real assets, right? This is still an inflationary environment. We don't see it going back to wherever you're looking in the world, almost going back to 2% within the next 2 years. We know that growth is slowing, but at the moment it's still positive. So this is where real assets can outperform your traditional equities and fixed income. But certainly, as you said, this is a really challenging time for investors, trying to figure out which bit of the market is not in free fall.
Seema, people like Cathy Wood then, who or Mr. Gunlach, who continue to argue that we're going to have deflation very soon, are they wrong, or do you just see us taking a different path? Explain why your view is so much different to theirs.
Yeah, I guess I struggle to see where the deflation is coming from. Unless you're really expecting a very, very deep recession, which is going to completely undo any of the growth demand, which then pushes down your headline, your core inflation into negative numbers. I can see inflation coming down over the next couple of months. Certainly, that seems very likely, especially as you get into that point where the growth starts to slow down. But are we getting back to a point of 2%, 0? Or is it more likely to rest around the 3.5%, 4%? I mean, if you look at over history, back to the 1980s, countries which had hit an inflation rate of 5%, how long does it take them to get inflation back to 2%? Well, on average, it's kind of 5 to 8 years, right? This things become sticky. That's always been the central bank's concerns about high inflation. Is eventually it becomes entrenched. You look at the US, you look at shelter inflation, medical services. These are things that don't change very rapidly. So you need a prolonged period of weakness in order to pull them down. So it's possible. For that, you need to have a very, very negative economic scenario.
One thing that also stood out to me, Steve and I sit around the desk, and obviously there's a lot of opacity as far as we're concerned in what hedge funds are doing, and you very often don't find out until they're forced to report, and it's all rear view gazing here. But you have a view on hedge funds more broadly. You're currently neutral on hedge funds at the moment. How do you think they're doing in terms of navigating this more tricky macro environment? Because from the reports that we see, they're either losing a bundle or making a bundle on the pound, or losing a bundle or making a bundle on the euro at this point. Are they covering themselves in glory?
Well, look, there's always going to be significant differences across the hedge fund sector. And I think, as you pointed out, some of the moves that some of the hedge funds are struggling with have been the extraordinarily violent ones. I mean, you kind of pointed out the sterling move. I don't think anyone really going into Friday morning would have anticipated the kind of violence, or even certainly the extent of the fiscal policy that we were expecting. So these are kind of moves which were unexpected. But generally speaking, you are seeing that hedge funds are typically de-risking. They're looking at the standard macro trades that we're looking at and saying, look, things are going to get very challenging over the next couple of months. Equities are going to be struggling. Potentially, this could be the time to move into treasuries, government bonds as a place of safety. Some of those trades, as you said, they're not working out. But at some point, we do believe that actually US treasuries are going to peak out relatively soon, and they will start to come down. And so I think that, yes, this is a difficult moment for almost all investors.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.